we talked about merchandising companies, right? We talked about the difference between merchandising companies and service companies. And we said that the main difference is what? We said that the main difference was that the main source of revenue is sales revenue, right? And which would also mean that before they can actually sell the product, they have to buy those merchandise. And when they buy merchandise, we learned that there are two different systems that companies use. We learned that there is the perpetual inventory system and the periodic inventory system. And in this chapter, we will be learning more about the periodic inventory system. Okay? So we learned last time how to record the purchase of merchandise. And we said that when you buy merchandise under the perpetual system, the company will be increasing their inventory. And if they pay in cash, it will be credit to cash. If it's on account, it will be accounts payable, right? And we also learned about the terms of sale. So if there is a discount, we learn how to make the journal entry to account for discounts, for returns, etc. Now we will be looking at the other side of the story, sales. And as you remember, we said that one of the most important differences in accounting for inventory under the two systems, perpetual and periodic, is that under the perpetual system, after each and every sale, the company will recognize the expense, which is called yeah, I know it's an expense. So what? So which expense is it? Cost of goods sold after each and every sale, and the company will also adjust the balance of their inventory accounts, right? So this is one of the most important differences. Okay? Now, today we will do the sales part of it. So, once again, the whole thing starts with this invoice, the sales invoice. As you remember, the original copy was sent to the buyer, and they keep the copy for themselves to make the entry. And here, we are looking at it from the point of view of the seller, not the buyer. Okay, so let's start doing that. I just said that it's an expense, and it's called cost of goods sold. I just mentioned that. Not a minute ago. Come on. Okay. So this is where we actually start recording the sale. And like I mentioned, after every sale, the company will make two journal entries. The first one is to recognize the sale, to record the sale, which is to recognize the revenue. The second one is to recognize the associated expense that comes with that sale. Remember, expenses, they follow revenues, matching principle. So the first journal entry is always to record the sale of that product. The company will be receiving cash if the sale was in cash. If it was on account, it will be a debit to accounts receivable. On the other hand, the revenues will increase, so they credit sales revenue. The second part of that transaction is to recognize the change in expense, basically in inventory, and to recognize the expense. Their expenses have increased. That's the cost of goods sold. Inventory will have decreased because they sold something. So their inventory level will go down. As a result, it's credited. Any questions? Okay, now there's one big difference. This is here. You look at the selling price. This is, for example, if you say that Best Buy, they sold TVs for $700. That's a sales revenue based on the selling price, how much they actually sold that product. The cost would be the cost of inventory. This is when they purchased that merchandise, which would include any costs associated, any costs that were incurred or expenses that were incurred to acquire that asset, that inventory. So it's not just the purchase price, it's the purchase price plus the shipping if they had to pay for shipping, plus etc., etc. Okay? So this is the cost of those products. Let's look at the example that we had here. So PW Audio Supply records the sale of $3,800. Remember, they sold them $3,800 worth of products on May 4th. And let's assume here that the cost of the merchandise was $2,400. So the cost of the inventory was $2,400. They sold it for $3,800. What's the journal entry that we have to enter here? We have to make the two journal entries. The first one is to recognize sale. How do you recognize the sale? Yes. Exactly. It's on account. So you debit accounts receivable, you credit sales revenue. We recognize the sale. We recorded the sale and we recognize this revenue. Okay, next.
Debit cost of goods sold $2,400 and then credit inventory $2,400.
Exactly. The level of inventory has decreased and it has decreased by the cost. Remember that here we're talking about the cost. Okay? Think about it if you want at this point, basically the cost of replenishing your inventory if you were to buy it, etc. So but this is the cost at which you acquired inventory. Okay? So you always have the same two transactions to record the same. On the buyer's side, we had one of them only. We recognize the payments and return for our inventory. Here we have two. You recognize the sales revenue and the expense, which is the cost of goods sold. Again, we also have sales returns and allowances. This is the other side of the story to purchase returns and allowances. Remember we talked about when you return something to Best Buy or to Walmart or something? Now, last time we learned how to record it from the buyer's perspective. Now, we are going to record it from the seller's perspective. Okay, so let's say in plain English, when a customer returns certain products, what happens? Yes, so basically what happens is that your cash or your receivables will decrease, right? So you credit them. Why? Because now you expect to receive less money or you have to return the money. And what's going to increase? Inventory, right? Here we have two journal entries, so we have to also make that. Again, you have to adjust, exactly. So you have to adjust for the revenue that you earn and the expense, the two of them. Companies, they do not decrease sales revenue directly. They use the contra revenue account. Okay? Why is that? We had contra accounts before, right? Yes.
Well, if you sold the thing on like October 30th, and then the person took it back on like November 4th, and it was like a different period. If you got the sales in the first period, and then when you returned it, your revenue went down for the next month, it would be like messed up.
Okay. What about if it was within the same month? So you purchased it in October 10th, on October 10th, and then you returned it a week later. You're still within October. So what do you do?
I mean, I don't know.
companies, they don't want to mess up with the sales revenue. They want to know exactly how much sales they made, and they also want to know how much returns they had. Why? That gives you, for example, if you had a high level of returns, what does that mean? You either have a problem with sales, or maybe tech support, basically like customer support, or it may be that you have an inferior product. Why are people returning your products? Then there's something wrong here. You have to fix it. Okay? So companies, they keep separate sales returns and allowances from actual sales revenue. It's in a way similar to when the company used the contra asset account for equipment. The depreciation and accumulated depreciation, rather than just decreasing the value of your equipment. So in this case, if you remember, we have $300 worth of products that were returned. So we returned $300 worth of returns. Here again, we are assuming that the cost was $140. Remember, you have to make two journal entries for the return. The first one is to recognize the return, which is a contra asset. This is the effect on the revenue in general. So this is a contra revenue account. Now, revenue has what kind of normal balance? Credit. So a contra revenue account would have a debit balance, right? Okay. So we know that this account has a normal debit balance. Did it increase or decrease in this case? It has increased, right? That's a negative account as far as revenue is concerned. So, the company would debit sales returns and allowances, the amount from the sales price. Okay? And then what will decrease, like we said? Accounts receivable or cash. Because now you expect less. Oh, you said it. I'm sorry. Sorry, my bad. You said it. So you will have less accounts receivable because it was an account. Okay? They owe you less. Your customer now owes you less. But because we are using a perpetual inventory system, now we need to also account for inventory and the cost of goods sold. You see, those products are not sold anymore. As a result, you have to remove that expense. Sure. Then it would be a credit to cash.
But you have to backtrack out of that system that's
Oh, definitely. Definitely. It's like when you go, for example, when you return something. If you paid in cash, they will return it to you in cash. If you paid in credit card, they will send it back to the credit card. They're not going to give you that in cash. And in certain cases, they might even give you store credit. That's a different thing. But in this case, what they will give you is actually, if you paid in cash, they will give it back to you in cash. If you pay using credit card, they're not going to give it back to you in cash. They will send it back to the company. They will cancel the payment or deduct that from the payment. It will basically credit your credit card. Okay? So in this case, the company credited accounts receivable to indicate that their customers now owe them less. The other part is expense and inventory. What happens to the inventory? Yes. It has increased. Why? They received those products back. It has increased by how much? 140. It did not increase. This is the cost, at cost. Remember, inventory is at cost. Don't get mixed up. When you talk about inventory and cost of goods sold, this is cost. When you talk about revenues, you're talking about selling price. Okay? So in this case, we know that inventory has increased by 140. So we debit inventory, 140. What do you credit? Yes. Cost of goods sold. Now, you recognize less expenses. Because basically, it's as if you did not sell those products. So when you record a return, you make two journal entries. The first one, you debit the contra revenue account, in this case it says revenues and allowances, and you credit cash or accounts receivable. And then you also recognize the inventory change. It has increased because you received those products back. So it's 140, it's debited 140, and your expense, cost of goods sold, has decreased. So you credited 140. Now, this is assuming that the products were not defective. If the products were damaged or defective, then you report them at fair value. You assume that, for example, you estimate the value of that product. Let's say that it was a TV and you found that it was, I don't know, the stand of that TV was broken. It doesn't have the same value anymore as the original TV, which was in a box that you could sell directly, right? Now it's like open boxes. When the company receives an open box item, they cannot sell it in the same way as they sell a regular TV, right? Am I correct? Okay, of course I am. I'm telling you that. So in this case, the company will have to record the cost at this value. They estimated the inventory, the value of the inventory was $50. The first entry would be the same thing because it was according to the selling price. It's the second part, you are still debiting inventory, but you debit inventory the value, 50. And you credit cost of goods sold again, 50. You see, in this case, we're assuming that we're estimating the value of the returned goods because they were damaged at $50. In the previous example, we estimated the value to be at 140 because it was not defective, so we used the original cost. It's the same thing. The only thing that changes is the value. One of them depending on the cost, the other one depending on how we estimate, how much you estimate the value of that damaged good is. Cost of goods sold is determined and recorded every time sales occur in which system? Only perpetual inventory system. The periodic inventory system, they will only calculate the cost of goods sold at the end of the accounting period. See, if you continue with that attitude, trust me, the average of the second exam will drop a lot. Don't blame me later on, okay? I'm telling you from now, you cannot keep the material until a day or two before the exam. This will be building up on the previous material. Next chapter will build on this one, etc., etc. You will have to learn how to calculate them. Be careful. Please read the material. So, now in the same way that we had purchase discount, this is the flip side of it. This is the other side of it. It's sales discount. And remember, one company's purchase discount is another company's sales discount. Right? One company's receivable is another company's payable. You always have two sides of the story. Once again, the companies here, they use a contra revenue account. They don't want to touch the sales revenue number. They want to keep that number intact. Instead, they use contra revenue accounts. So what's the contra revenue account here? Sales discount. Remember what in the purchases, what was the account that was used? So we had the payment in cash, right? We had accounts payable and yes. No, unearned, they made the sale, so it's earned. Unearned service revenue is only when you do not give the service. Yes. Sorry? No, you do not include that in the entry. So payment term is not included in the journal entry. It tells you what to do when you want to make the journal entry. It was inventory. Remember that what we said at that time, that the cost of this inventory has decreased, and you record the inventory at cost. So because the cost of the inventory decreased, you credit inventory. That was how we made the journal entry for purchases. as you can see, it started to get a little bit more confusing than the first 4 chapters. Remember that when you start. So companies want to calculate the net sales. Remember that the net sales is used to later on calculate the gross profits. Right? So net sales is simply the sales revenue minus the 2 contra revenue accounts. Okay? So it's sales revenue minus the returns minus the discounts. So this is how you actually record it. So on the financial statement, it will look like sales revenue less sales returns and allowances, and then you have less sales discounts. That will give you net sales. You subtract cost of goods sold from net sales, it will give you gross profit. Okay? So, assume Subscale pays the balance due of 3,500. So it was 3,800. We subtracted the 300 that were returned on May 14th, the last day of the discount period. Remember that in the problems, in the homework, in the exam, you might not be given, you might not be told that this is the last day of that discount period. They will simply tell you that it was paid on May 14th. You have to pay attention to the dates and the terms of sale. Okay? Remember, now you're playing the role of the accountant. No one is going to tell the accountant that, okay, this was paid during the discount period. They will simply give them the invoice and the payment. Period. They have to actually know that. So you have, in your case, you have to know that this was during the discount period. How does the company record it? So on May 14th, the company will receive what? The buyer will receive a discount. Here we'll talk about the seller. This is one of the biggest problems in this chapter, is that one of the difficult things is to distinguish between a purchase and a sale. Here we're talking about the seller. Keep looking and think about it from the seller's perspective. Yes?
They received $3,500.
They received $3,500 in cash. Right? So their cash increased. They debit cash, $3,500. What was the amount? Oh, sorry, put it in the wrong order. Now, that would have been correct if there was no discount. So with a discount, without a discount, they received $3,500 for the debt. When you say the debt, that was accounts receivable. Accounts receivable is still $3,500. But there was also a discount of $70. You remember that? 70 is simply the 2, because it was 210. So it's 2 multiplied by 3,500. 2% multiplied by 3,500. Okay? So the company would receive the cash minus the discount. In this case, the company will use sales discount. When we were looking at the other one, if you remember here, that was the purchase. So on the purchase, accounts receivable is always, or accounts payable is always the full amount. That was the debt. The original debt was $3,500. So accounts payable, and on the seller's side, accounts receivable was $3,500. When you look at the payment, the amount of cash that was exchanged was equal to $3,500 minus the discount. In this case, we had credited inventory because it affected the cost of inventory. As far as the sales is concerned, the company will use sales discount. Okay? Any questions? Okay. Now, I again, if the company had paid after May, let's say end of May, they would have paid the full amount. It would have been cash debited, 3,500, accounts receivable, credited 3,500. That would have been the case if it were paid in after the discount. So this is after discount period. Within the discount period, we had to recognize the discount. So it was paid less than discount. Adjusting entries. You remember that we said under the perpetual system, what the company is going to calculate inventory after each and every transaction. They still conduct a physical count at the end of the month, for example. Why is that? For control purposes, to make sure that the number that they have on the book is actually what they have in their warehouse. Why is that? There could be a difference in the numbers between what is actually there and the number that they have on their books. What could have happened? Why would the company have different numbers? Yes. Theft, employee theft, custom, even like shoplifting, damage, waste. So someone by mistake they dropped the TV, they broke the TV. It doesn't exist anymore. So they have to adjust for it. Okay? And this adjustment would actually affect the couple. Think about inventory and cost of goods sold under the perpetual system as a couple. What affects the first one will affect the second one. Okay? Because in this case, your inventory will, for example, decrease, right? And that will also happen to what? That means that this is an expense. So suppose that PW audio supply has an unadjusted balance of 40,500. The physical count shows that they actually had 40,000. What happens to their inventory? What do you need to do to their inventory to make it to adjust the number? Sorry? You need to credit inventory. You need to decrease inventory by 500, right? And this will be a debit to cost of goods sold. So what happens here is that you're saying that, okay, this is an expense, it's added to the cost of goods sold of that period. Because it was broken, so for example, it was broken in mid-October, it will be added to the cost of goods sold in October. That was an expense, part of the expenses, part of the cost of inventory that were sold. At the end of the month, you cannot leave it unadjusted. You cannot leave inventory balance at 40,500 when you know that you do not have that amount. You do not have 40,500 anymore. You have 40,000 only. Think about it as TVs. You don't have 100 TVs anymore. You have 98 TVs. So you cannot keep saying that, okay, I have 100 TVs. You don't. But the cost of those 2 TVs that were broken or stolen or whatever, or disappeared magically, those will be added to the cost of goods sold during that period. Okay? Again, closing entries. So as you can see, those are from chapters 1 through 4. So you're not going to be asked questions from the previous chapters, but if you are asked to close the inventory or something like that, you will have to know how to do it. So don't tell me later on, oh, you asked me a question about debits and credits. That was from the first 4 chapters. Well, it will be across the whole semester. Now, once again, you close the credit account by debiting them, and the debit account by crediting them. So revenues, they have what kind of account? They are what kind of account? Credit. So they have normal credit balance, you debit them. So we debit the revenue, we credit income summary in the same way. So we had other types of revenues, service revenues, we did the same thing. Contra revenue accounts. what balances do they have? Contra revenue account. What normal balance do they have? Debit. So what do you do to close them? You credit them. Remember, if you want to close them, that means you want the balance to be zero. So for example, sales discounts was 8,000, had 8,000, right? Oh, sorry. You want to make it zero, you credited 8,000. The balance now is zero. And this, you credited this one, so you debit that amount to income summary. The same way that we did before. So you close the accounts that have normal debit balance, such as expenses, including cost of goods sold, contra revenue accounts. Those accounts will be credited and will be closed to income summary. The last two are like before. You close income summary to retained earnings and you close dividends to retained earnings. Period. Any questions about this? So the trial balance of Celine Sportswear shop at December 31st shows inventory 25,000, sales revenue 162,400, sales return and allowances for 800, sales discounts, cost of goods sold, net revenue, freight out, rent expense, salaries and wages expense. We need to prepare the closing entries. Remember, when you will do the closing entries, what do you always start with? Revenues. Revenues have credit balance. So what do you do? We debit them. So what's the first one to debit? Sorry? Sales revenue. You debited 162,400. Next. Sorry? Income summary. What about rent revenue? That's also another revenue. You have to pay attention to that. A lot of companies have more than one source of revenue. Most companies actually have more than one source of revenue. So you have rent revenue also. We also debit rent revenue, the value. Now what do you include here? Income summary for the sum of the two amounts. Next, what do we do? So that was the first entry, first closing entry. Remember, you have 4 closing entries. First closing entry was to debit the credit accounts. Now we credit debit accounts. So what do we have? Okay. What about inventory? You debit it or credit it? Okay, so let's do it this way. So we have income summary. This is the one that will be debited, right? Because you're crediting the other account, so you will debit the income summary. Then you have cost of goods sold. So let's do that. So cost of goods sold. We're done. What else? Sales returns and allowances. Sales discounts. Freight out, right? You have also what? Rent expense. Salaries and wages expense. Why didn't we include inventory? It's a permanent account. It's an asset. So it's a balance sheet account, not an income, not an income statement account. Sorry? Yes, I did. Expect stuff like that also in the exam. Yes.
Is there a specific order we should
To be honest with you, software company, it depends on the company. Most companies use, a lot of companies, they use it in, like you said, in order of magnitude. Others, they use it in alphabetical order. So there isn't like really just one way to present them. The ones that are in order of magnitude are usually like current liabilities. You have notes payable, accounts payable, and then they are in order of magnitude. Current assets, for example, they are in order of liquidity, how fast you expect to convert them to cash. So it depends on each part of it. It's not like it's not always in order of magnitude. Sometimes the book would just put it in order of magnitude because it looks easier for you to grasp. And then we have the remaining two, which are to close. The remaining two, the other two journal entries were to close. Income summary, to retain earnings, dividends, to retain earnings. That's the same as before. So there are different ways of preparing an income statement. You have the multi-step income statement and you have the single-step income statement. The single-step income statement is much simpler. You have one step, basically you list all revenues, you list all expenses, and the difference between the two will be net income or net loss. This is very similar to what we did before. On the other hand, with multiple step income statement, companies group them differently. They provide you with more information. So in this case, a company will provide information using, for example, they will show, for example, the difference between cost of goods sold and other expenses. That will give you what? That will give us gross profit. And then they will also list operating activities. So they will calculate net income from operating activities. After that, you have non-operating activities. And why do companies like to separate between operating activities and non-operating activities? Why do you think that? All these are basically valid answers. All these are correct. The main issue is that the external user, let's say that you are an investor or creditor, when you look at operating activities, you believe that this is a sustainable source of revenue. You expect the same amount, more or less, to happen every year. Non-operating activities have to do, for example, if you gain from when you sell a truck. So you sold a truck and you made some profits from selling the truck that you have. That gain, it's not going to happen every year. It's going to happen only when you sell that truck. So if you sell a building and you make a profit out of that, you gain out of selling a building, that's not going to be happening every year. So when you want to analyze the profitability of the company, some people discount the information. They don't give it the same weight as operating activities. Operating activities, they come from sales revenues and service revenues, etc. So those are expected to happen every year, right? And this is why companies, they actually provide this multiple-step income statement. It provides the users of information with more details. Now, sometimes companies use more than one account for sales revenue. So they might have TV sales revenue. So Best Buy might have computer sales revenue and TV sales revenue. Usually they use that information for internal purposes. They want to see which line of products produces more. Apple, for example, might have a line for iPhone 6, iPhone 6 Plus, iPad Air 2, etc., the iPad Pro, etc. So they have different accounts. They want to know which product is actually making more profits than the others. But when they actually list it on their income statement, they don't give that detail. Why? It could be needed, it could be very useful, but there's an issue here. Do they want their competitors to know that information? Do they want, for example, Samsung to know exactly which product is selling more? Because in this case, if they know exactly how much they are selling from iPhone 6 compared to iPhone 6 Plus, they might say that, okay, in this case, people, they like this form, they like this size. As a result, they might make a new product with that same, with those features or specifications. So they don't want to let everyone know details about their operations. So in the same way that they don't give always detailed information on their customers, etc. They want to keep that a secret. So they might have different sales accounts. When they list it on the income statement, they will list it as just one aggregate number, one cumulative number. So the first thing is on a multiple step income statement. Companies will list net, but they want to calculate net sales. So they start with what? Sales revenue, right? Less allowances, less sales returns and allowances, less sales discounts. Right? So they have all these accounts. That will give them net sales. So this is the actual amount that remained from sales. The returns and discounts, the company actually never received that money. Now this amount will be used to calculate gross profits. The next step would be what? To calculate what? Or to list what? Cost of goods sold. And like we said, company can calculate the cost of, we will learn actually how to calculate the cost of goods sold using different methods, different inventory estimation methods in next chapter. So far we're being told that, for example, assume the cost of this inventory is such and such, right? Later on we'll learn how to, next chapter we'll learn how to calculate. Now, net sales minus cost of goods sold will give you gross profits, okay? So this one minus this one will give you gross profit. Now, a lot of companies, instead of using just the gross profit, what they include actually is the gross profit rate. Gross profit rate gives you the same information, however, it gives it in a form of percentage. Instead of saying that, okay, the company made $144,000 as gross profit, the company might use a percentage. They divide the 144,000 by the net sales. That will give them how many cents from each dollar of sales, of net sales, the company gets to keep. That's not the end profitability, this is not the net income. We still haven't paid our operating expenses yet. But just how much remains after paying the cost of those products. You sold the products, and then you calculate the cost. The gross profit is the money that remained after paying the cost, before paying before paying your salaries, before paying rent, etc. Now, why do companies use the rate or percentage? Because it gives an actual idea with the number, with an absolute number. Might be misleading. So if I tell you, for example, that the company made gross profit of $100,000, is it impressive or not? Okay, if I tell you that the net sales were actually 150,000, so out of 150,000, 2/3 of that money were actually gross profits. That's impressive. If I tell you that the company made $100 million as gross profits, is this impressive? Or even $1 billion in gross profit, is this impressive? Yes. Well, it depends. What if it were Apple? Then no, it's not. Because their revenues are much, much, much higher than that. So basically they made a gross profit of 2% or 3%. That's pocket money to them. I mean, if I was Apple, I would be happy with that amount. Definitely very happy, but unfortunately I'm not. So that $1 billion might be deceiving, might be misleading. So this is why companies sometimes they report it as gross profit rate. The gross profit rate is simply you divide the gross profit by the net sales. That could be, for example, an example in the exam, a question in the exam. Calculate the gross profit rate. What's the gross profit rate? Or you might be given, for example, gross profit rate, and you have to calculate the cost of goods sold. So you will have to do it backwards. Like reverse engineer how we got to gross profit rate. You start from gross profit rate to gross profit and net sales, and then you calculate the cost of goods sold. Okay? After that information, the company will start listing operating expenses. So the first part was to calculate net sales and gross profit. After that, the the company starts listing operating expenses. Those include salaries expense, salaries and wages expense, rent expense, advertising expense, supplies expense, depreciation expense. All these expenses will be listed under operating activities. Okay, so you have operating expenses. It will give you the total operating expenses. Subtract that amount from gross profit. So this is why they call it multiple step. We started with sales, we got to net sales. We subtracted from that cost of goods sold, we got to gross profit. From gross profit, we subtract total operating expenses, it will give us net income, or income from operating expenses. Income from operations. Sometimes they also call it operating income. So it's all the same thing. Operating income or income from operations. But that's not the end of the story. That's not your net income. You still have other revenues and other expenses. For example, Best Buy might have their money in the bank, right? As a result, it will accumulate what? Interest. But is interest their main line of business? So it will be listed under other revenues and gains. The example about selling the truck or the building for higher than its book value, that is a gain. That will be listed under income, basically under other revenues and gains. So this is where you have, for example, you have interest revenue. You might have dividend revenue. This is if the company has invested, if Best Buy has invested in Apple's stocks. When Apple gives or declares and pays dividends, Best Buy will receive that dividend because they are investors in this case. This is dividend revenue. So it is separated from operating expense, from basically the operating income, because companies they want to make sure that operating income comes from the main line of business. So non-operating activities will list other revenues and gains, and also other expenses and losses. This is, for example, you have interest expense. Now it's the other way around. Interest expense is not something directly related to, for example, paying salaries or your rent or your utilities. But you still have to pay interest expense. This is included as other expenses and losses. Once you have those amounts, so actually this one, it shows you the kind of other, basically other revenues and gains and other expenses and losses. And we will be addressing those as we go ahead with our chapters. For example, when we talk about equipment, we will learn how to calculate gain from the disposal of equipment. When we talk about investments, we will talk about dividends, etc., etc., etc. Okay? So once you have this information, now we have income from operations. You add other revenues and gains, and you subtract other expenses and losses. That will give you the actual net income of the company. This is the net income that you end up with. So the company in this case, instead of just listing all revenue and all expenses, which will tell you about the profitability of the company, you will end up with the same number. So you will end up with having the same net income or net loss. But it's the intermediate information, it's the information that is in between, that is not given in a single step income statement. For example, what's the gross profit rate? What are the other revenues and expenses, etc. So usually companies, when they look at, or when financial analysts, investors, creditors, etc., when they actually analyze a company's income statement, they pay more attention to income from operations than to the other ones. Why? Because this is the actual amount that is supposed to be recurring, that is expected to be recurring, because this comes from the sales of the company. They don't depend on whether the company sold a certain building or truck or something like that. Or whether the company they are investing in declared and paid dividends. What if next year Apple doesn't pay dividends? So this depends on the other company, it does not depend on the company itself. As a result, for operations, basically to see if the company is actually doing well, you look at most companies, most basically users of information, they look or they pay more attention to income from operations. Okay, that's better than before. Still not as good as others, but I mean, previously you used to do much better than that. However, just to encourage you, I'm going to give you a smiley face. Don't make me regret it. So the single step income statement, this is usually used by companies because it's simple and it is, and especially if the company doesn't have a lot of other revenues, etc. It will simply put all, to list all revenues together, all expenses together, and then it calculates net income. This is what we've done before. Remember that from previous chapters? Please tell me yes. Okay. That was scary. The balance sheet, when we look at the classified balance sheet, this is exactly the same as before. The only thing that is added here is inventory, and it's usually added right after accounts receivable. Remember that we list assets in order of liquidity. Inventory is a little bit less liquid than accounts receivable. Why is that? Because you need to sell those products, and then they become receivable. Okay? So basically, inventory is slightly less liquid than accounts receivable. So we list it right after accounts receivable. Now you are presented with the following list of accounts from the adjusted trial balance for merchandiser for this company. Okay? We need to indicate in which financial statement it will go. So for example, accounts payable, where does it go? On which financial statement? Balance sheet. And it will go under current liabilities, right? Accounts receivable. Balance sheet, current assets. Accumulated depreciation for buildings. Balance sheet, property, plant, and equipment. Remember, as building. Accumulated depreciation for equipment, balance sheet, property, plant, and equipment. Okay, advertising expense, income statement, it's operating expenses. Buildings that are used, when you say building, this is used for operation. It's not investment in buildings. Remember that if a building is used as an investment, it will be called long-term investment. But when you have a building, when they simply say building, here, the underlying assumption is that this is a building used for business operations. So it will be balance sheet and property, plant, and equipment. Cash. Okay. Common stock. Balance sheet, stockholders' equity. Depreciation expense. Income statement, operating expenses. Dividends. Sorry? Do you put dividends on balance sheet? Retained earnings. This is the deduction section. This is less dividends. The only time that you put dividend on the balance sheet columns is on the worksheet. It does not mean that it will actually go on the balance sheet itself. Equipment. Balance sheet and property, plant, and equipment. Hence. See? Freight out. Income statement, operating expense, right? Gain on disposal of plant assets. Plant assets are also called sometimes fixed assets. This is like property, plant, and equipment, right? So gain on disposal of plant assets. Income statement, other revenues and gains. Insurance expense. Income statement, operating expense. This is something that the company needs to operate. Interest expense. That expense. Interest expense. Income statement, other expenses and losses. interest payable, balance sheet. And this is a liability, current liability, inventory, balance sheet, current assets, land, balance sheet, and property, plant, and equipment. Notes payable, long-term liabilities. Usually the assumption is that most notes payable are due in several years. Now, notes payable that are due this year will be current liabilities. They are called current maturities of long-term debt or something. So property taxes payable, balance sheet, current liabilities, salaries and wages expense, income statement operating expenses, salaries and wages payable, balance sheet, current liabilities, sales returns and allowances. And it is sales revenue. You put it on the sales revenue. This is a contra revenue account. So remember, although it is not a direct revenue, this is a contra revenue account. You always list it at the same time. It's like accumulated depreciation. You always list it under, for example, equipment or building. Sales revenue, income statement revenue, and utilities expense, operating expenses. Any questions? So now we will look at how the company would record purchases and sales under the periodic system. Okay? In this case, you remember we had with the perpetual system, we had to account when we were doing the purchases, we were debiting and crediting inventory all the time, right? Under the periodic system, companies, they use different accounts for that. Those are temporary accounts. But they use them to all calculate the ending inventory. So in this case, they use different accounts. For example, let's start by giving examples. The main parts here are the same. You have inventory, beginning balance, you add net purchases, right? You subtract the sales, bless you, and then you end up with the ending inventory. So you would always have that one, this one. You have beginning balance of inventory plus purchases, net. By net we mean any, like after subtracting any returns and allowances, etc., right? And then you have, that will give you the cost of goods available for sale, right? Available. Subtract cost of goods sold, it will give you ending balance of inventory. So you start with inventory. You add purchases, less returns and allowances and discounts. That will give you net purchases. Now, under the periodic system, you call it freight in. So you will call each one by its name. With freight in, like with the perpetual system, when the buyer paid for shipping, it was added to the cost of inventory, right? So we debited inventory. In this case, the company will debit actually an account called freight in expense. Freight in, not expense, sorry, freight in. Those are temporary accounts that they will all be used to calculate the same amount. This is the same number that you would have eventually that you would have from the other one. So this is the cost of goods sold. Okay? Now, again, we go back to the same example. So PW, audio supply. Now we're looking at it from the buyer's perspective. So South Stereo, they report the 3,800. In this case, did they pay in cash? No, it was on account, right? So it was purchased on account. By the way, just to let you know, and we'll talk about that later on. usually, when does a company record the sale? It's when the ownership of that inventory is transferred from the seller to the buyer. This is when the actual obligation this is when the revenue is recognized, and this is when, for example, the company will actually record the purchase. So on that day, the company purchased for $3,800. So the company will debit an account called purchases, and we credit accounts payable because they didn't pay the company did not pay in cash. It was on accounts. When we were using the perpetual system, it was like this. It was inventory. So we used to debit inventory directly. Here the company will simply say, okay, so this is called purchases. What about freight expense? Freight, the shipping cost. So freight cost, if it was paid by the seller, it would be freight out or delivery expense. In this case, it was paid by the buyer. So the company will debit freight in and credit cash. Okay? That's actually simple, right? Instead of thinking about it from the inventory perspective, here you call it the way you see it. You purchase certain merchandise, you debit purchases. You pay for shipping, so you debit freight in account, okay? And then you credit cash. When we were using the perpetual system, the company actually debited inventory because it was added to the cost of inventory. When the company returned certain products for $300, again, under the perpetual system, we looked at it from the point of view of inventory. How did it affect inventory? And how did it affect cost of goods sold? In this case, what happens? So you were looking at it when it was under the perpetual system. We looked at it, how did it affect inventory and the debt to their supplier or to the vendor. In this case, we look at it from, it was returns, right? So the company will call it accounts payable. So this is, again, the same thing. They will owe less. They will debit accounts payable. They will credit purchases, returns, and allowances. When we were using perpetual system, it was inventory. We were only making changes to the inventory level because it was affecting the cost of inventory, and we were calculating the balance in inventory after every transaction. So this is the difference. With a periodic system, you use those temporary accounts because those ones will not be actually showing up until basically when you eventually transfer all the information to the ending balance of inventory. So all this intermediate calculations is not in use. This is why with periodic system it's much complicated to actually look exactly at each point in time and to see the balance of your inventory. Whereas under the perpetual system, after every transaction you are adjusting your inventory level. On May 14th, Stock Stereo pays the balance due on account to PW Audio Supply, taking the 2% cash discount allowed. So they took advantage of the discount. How much cash the company received? And the company paid. It's $3,500 minus the 2% discount, which is $70, right? So this is the amount of cash. It's going to be cash. How much do they owe them? $3,500. So the debt will be erased. Accounts payable will be debited $3,500. Cash will be credited $3,430. That's $3,500 minus the discount. But again, instead of using inventory, because at that time we considered the cost of inventory, now we actually credit it to purchase discounts. The sales of merchandise is simpler here. Why? The company is not going to actually record the cost of goods sold and inventory, the second journal entry. So they will only recognize the sale. which is to mean they will only report basically the sale and they will recognize the revenue. So it was accounts receivable 3,800 debited 3,800 and we credited sales revenue 3,800. When they return when the customer returns the product, okay, what happens in this case? The company will debit sales returns and allowances, credit accounts receivable. They are not going to do they are not going to actually recognize again. They are not going to adjust inventory and cost of goods sold. When they also have a discount, company received cash 3,430. They also have sales discounts and accounts receivable was credited the full amount. Okay? Now, this slide, it shows you the differences between the two systems. Under the perpetual system, when we purchase merchandise, we debited inventory and credited accounts payable. This is the summary of all the chapters, of all the two systems. Whereas compared to that one, we have purchases, freight in, purchase returns and allowances, and we have purchase discounts. Using the perpetual system, it was always inventory. And on the sales part, we calculated the cost of goods sold after every transaction. Here, there was no entry for the cost of goods sold. Any questions?